In this episode of On the Tape, I welcome Phil Rosen. Phil is co-founder and editor-in-chief of Opening Bell Daily, which he started with Anthony Pompliano. An avid reader and writer, Phil goes through his journey from travel blogger to financial journalist and everything in between. While Phil's age puts him somewhere between a millennial and a Gen Z, he's an old soul and a student of market history who goes out of his way to share his wisdom to his readers. We are lucky to have him today and get his insight, so please enjoy this episode of On the Tape. Today, I'm thrilled to welcome Phil Rosen to the pod. Phil is co-founder and editor-in-chief of Opening Bell Daily. You've written 2 books, both bestsellers on Amazon. We're going to get to that. You've lived on 3 continents. You've obviously traveled the world. One of the books was about that. You're a Fulbright scholar. It's great to even be in your presence. Thanks for being here. And you used to work at Business Insider, and your articles appear in many periodicals. So, Phil, welcome to the pod.
Thank you, Danny. We should spend more time together. That was a great intro.
Thank you, man. Well, listen, you're born in 1996. I'm doxing you because I do that to young people. And I find that always really interesting, and I'll get to why. Because you're too young for the dot-com bubble. You're 3 or 4 years old, obviously. Old enough to know as a preteen and teenager, global financial crisis that went on, right? The great financial crisis, whatever you want to call it. And then COVID hits. So you've seen a lot in your young age. And what's really interesting about it is you're a prolific reader. We're going to get to that as well. And writer. Talk about what got you into journalism in the first place, because it seems like you were almost born to write.
Well, I hope so, because I'm certainly trying to make a living doing it. I think I really look at journalism as the job of curiosity. So I'm interested in a million different things, but what journalism and reporting does for me, it allows me to pretty much research whatever I'm most interested that day, and then I get to write about it and talk to people like yourself about it. And that's a pretty good setup I have. You know, I don't think there'd be anything I'd rather be doing, because really my job is reading and then I write. And I do that over and over and over again. And this all started many years ago with a reading habit that came from my dad for sure. And I've been reading reading 50 books a year for a long time. And at that pace, that eventually pushed me into writing, because I was like, wow, the natural next step of expanding as a thinker and a reader and someone who's interested in a lot of things is trying to articulate my own thoughts. So that started in college, right? So then that eventually pushed me into this media journalism world.
So you found your way into writing about Wall Street financials, but it couldn't have been that. It could have been anything. So what drew you to, was it the 2008 crash that always piqued your interest, or what was it?
So I think I have almost no memories of the 2008 crash from my own lived experience. I've certainly read a ton of books since I've been old enough to, but I would say I went to journalism school and I took my first business reporting class. And my professor at the time, he said, no matter what anyone tells you in media, every single story is about money. And that opened the world to me, because at the time, I was like, well, I really love sports. I really love politics and culture and history, and business journalism was sort of on my radar, but I hadn't thought of it through that framework. And when he said every single story is about money, it was off to the races for me, and that's what I ended up focusing on.
And that was USC out in California, correct?
Yes.
Okay. So you graduate, and then you decide you're just going to go travel the world for a couple of years. And is that correct, in 2018?
Yes.
Okay.
So my undergraduate in San Diego State, I was a kinesiology student, so I was a pre-med, exercise science. I was taking all the chemistry, physics courses. And at the time, I was on pace to go to graduate school in physiology. And I thought that would be interesting, and I thought I'd be a professor, teach science. And maybe my junior year, I started taking philosophy classes. And that allowed me to really challenge myself intellectually much more than the science classes. And then that made me also postpone my plans for graduate school. I thought, I need to go see what's out there besides staying inside the ivory tower, because I've never really done anything else up to that point. I've always, obviously you go to school and you graduate, and then a lot of people just stay in school, and I didn't want to do that. So what I did, I moved to Hong Kong because I have relatives in Hong Kong, and I was teaching English to 3 and 4 year olds. And when I was there, I decided, okay, I'm going to start a travel blog because I want to be a writer, but I have no idea how to be a writer. So let me just start publishing words on the internet and see what happens. And I did that for about 6 months. And then the travel blog got me a job at a newspaper in Hong Kong.
And then from there, you decided to write a book, Everywhere But Home, correct? And you traveled the world, which ended literally during COVID in Germany in 2020. So you're traveling the world. I don't know if your trip was cut short or not. I'm not sure how much more you were going to travel at that point, but tell me about that experience about, being in Europe during COVID breaking out.
Yeah. So the way I got to Europe was first in Hong Kong. I was living there, working at this paper. And then, you could almost say democracy was starting to collapse on itself in Hong Kong in 2019. And that eventually was my reason to leave Hong Kong. It was getting very uncertain, very restless, not that safe for expats. So I left, came back to the States. And then eventually I found myself in Spain and then Germany in the start of COVID. So I was there actually to meet my now wife, and we ended up getting locked down in Frankfurt, and we were staying with my relatives there. So we were there for an entire summer, I think, just about, and then we were able to come back to the States, where I then went to graduate school at USC in California.
So that book, that I guess the moral or the question that came out of the book was, what are young people really supposed to do in life? So that was kind of the message out of this travel blog. And so I'm glad you got to travel. And by the way, congrats. I know you just got married.
Thank you.
On that. So that's great. I just had my wedding anniversary. I'll just say that your age is the same amount of time as I've been married. Well, people can figure that out, I think, from the earlier comment. All right. So you do that travel, and then you come back, go to grad school, correct? Then you come out, and you start working at Business Insider. Did I skip over anything there?
No, that all sounds great.
All right. So you're Business Insider. Now you're writing daily, many times a day, about what's going on in the business world. What was that like, since you kind of geared from writing this book about travel, reading books, some of them have to do with business, to going in and writing Business Insider? What was that experience like?
So when a lot of journalists that are graduating these days and they ask me, hey, how should I get a job, or what kind of beat should I cover as a reporter, I always tell them that your beat chooses you. It's not the other way around. Because I think, and I fell in this too in graduate school, I was trying to figure out what I wanted to write about. But really, in your first year as a reporter, your goal is get a job and make a living. So I got a job at Business Insider, and I had no specific beat I was looking for. I just knew I was happy with the job. And when I got there, my editor effectively told me, you're going to cover markets, financial markets. And I remember I responded, I said, hey, I have no finance background. I was a pre-med student. I have some philosophy training. I don't know what I'm doing. And he said, don't worry, you'll be fine. And really, that was a great lesson in how through reps, you can pretty much learn anything in the world. So I was writing 3 to 5 stories a day about financial markets, covering stocks, the economy, Federal Reserve, all this stuff. And I had great editors to really coach me up and show me how to talk about these things in a way that didn't make me sound so stupid. So through thousands of articles about this one beat and topic, that's really how I would say I sort of cut my teeth.
And that was, you had no preconceived notion, which is actually great because you had a blank slate coming in. So you weren't jaded one way or another, because you had massive inflation happen from all the stuff. So you got to see that play out in real time. So while you're there, though, it obviously didn't satiate you enough, because you wrote another book in your spare time while you were there. I think you say you write 30 minutes a day or something. And that was Life Between Moments. And it's a collection of fictional short stories that happened in New York City. Talk about that, because you obviously read a lot, you write a lot. It seems like you always got to keep your brain moving here. And that really had nothing to do with Wall Street either.
No, there was no Wall Street at all in that book. And really, I think I was getting restless on the job. That was a couple years into Business Insider. And I loved what I was writing about and what I was reporting on. I was meeting amazing people. I was interviewing super smart investors and fund managers. But I've always, I've read a lot of fiction, right? So I've always loved short stories and novels, and I really love classic literature. And I really just started writing about the things I was observing and seeing around New York City, and I was fictionalizing some of those things. And then I wrote for about a year. I was publishing these short stories online, and then eventually I sort of serialized them, put them into a book that I self-published myself. And that was the fiction book. So suddenly, as a Wall Street reporter, I had this short story fiction collection, And I don't know if that's really, I certainly don't talk about it that much. And you're probably the first one that's asked me about it in over a year since, it's been a long time since I've even thought about these stories. But this was a way to flex the muscle, I think, and try to stay in practice with some of the more literary devices and techniques that I had learned before. And I do think one note on fiction writing as far as financial reporting goes, I think it's helped me a lot because it's sort of training in empathy, right? So to write and read fiction, you have to really empathize with your own characters and the characters you're inventing. And when you bring that into your real life financial reporting, it makes everything much more human, I think. And I would like to think that when I write about finance, there's a great human element to it. I'm sure I have a long way to go as far as improving it, but I try to keep it top of mind.
It feels like a lot going on in this world, not just the business world right now. It feels like fiction, but it's not. So it's real. So you're well prepared for that. All right. So Business Insider, you leave there. You wanted to do something more meaningful. So you started Opening Bell Daily about a year ago with Anthony Popliano, right? And tell me about that and the mission behind it, because it's great. You have almost 200,000 subscribers that receive this stuff daily, and it's free. And then there's a special paywall stuff with special stock picks in it. And I promise we're going to get to all that stuff right now. I just wanted to get the background here. But tell me about what prompted you to kind of leave Business Insider for more meaning, I think, in your life and kind of help people and investors out there.
So I've always been extremely interested in building things and having projects, right? So when I was at Business Insider, I've always had my blog going on the side. I wrote books on the side during school and during Business Insider. And I was really, I was feeling restless again in my third and final year at the company. And what I had been doing also for most of my time there, I was writing Business Insider's daily markets newsletter. And the company eventually shut that down a few months before I left. And when that happened, I was blindsided. I was feeling all these mixed feelings. I'm like, well, I know I don't own the business, so I have no say in it. It's not my thing to worry about necessarily. I'm just here to do a job and do what they tell me to do. But I definitely wanted to be attached to my own product again. And that led to Opening Bell Daily. And working with Anthony has been an amazing experience because I think what we bring to the table is a very unique view on markets, and it's sort of modern internet native retail investor focused markets. And I think that there was a gap in the market for this as far as the business and finance media landscape. So what we try to do is we try to say intelligent things without dumbing it down for retail investors, because one of the things that we believe as a company is that the internet is a lot smarter than, let's say, it's represented in media. So retail investors on Twitter or X, they have been right on so many different things that the media has been wrong on in the last 5 years, let's say. And I think that is something that we are trying to lean into and trying to be on the side of the retail investors on the internet that have been smarter than the economists, the media. I think this year, in the last 7 months, right, economists have been wrong on inflation every single month of the year. And that continued this morning as we're filming. So that's something we're leaning into. And I certainly just would not envision doing anything else. If I always joke, if our company were to get acquired, probably the next day I'd just start another newsletter. So that's I feel very excited to be building this.
So there's a collective intelligence, right, online you're talking about between Reddit as well. I would throw that in as well. But it seemed to get a little bit, it accelerated through COVID, right, when
Yes.
people were home. And you were at Business Insider during the time, but you watched it happen. So now you're right in the throes of it. And from the stuff that you write, the people that you interview, the stats that you put out, there's a cautious tone about you in terms of just trying to help people. You're not saying, hey, you're not saying the markets, get out of the market. You're not saying that all. But you kind of, feels like to me at least, part of your messaging is, let me help you be a little bit smarter. I'm not going to try to change your mind. So it seems like you have that. Am I right to sense that stuff that you bring to the table, just trying to educate the retail investor?
I'd like to think you're right, and I try to be as helpful and useful as possible to our audience. Something I try to do, we all have our own biases we bring to the table, but the thing about markets is you can just look at the market and see what it's doing, and that will cut through all the political biases that you might be carrying with you. So I try to write everything based on the data I'm reading, and I go through a lot of data every single day. And, I do bring my own views to it. However, everything I do is backed by numbers. At least I would like to think. And I'm sure every markets person wants to think that all their decisions are backed by numbers, but I certainly show my work as best as I can. So if I want to, let's say, make the case for the Fed cutting rates, which they haven't done yet this year, I'm going to look at all the economists and all the inflation data and look at the labor market data and really lay out the case as consistently as possible and look at the charts. And I do a lot of data visualizations. And I think not all our readers will agree with what I'm saying. Let's say for the Fed's cut rates, some people think they should hold. That's fine. But I don't think anyone could fault me for not showing my work and showing my line of reasoning. So I think that eliminates the political noise in what I'm writing, because I'll say, look, these numbers lead me to this conclusion, and that's what we're writing today. It's not so much, hey, I just believe this, and I'm believing this because so-and-so said so, or because the party line says so.
Well, you're trying to figure out what is the driver of the markets, what brings more money into the markets. The CME Fed Fund futures, for instance, right? They're 92% chance of a cut. We've been at that for almost a week. Like, we've kind of been bouncing around. But so it's built in. So it's not like anyone doesn't see that coming per se. But what's amazing about this market has been 30 years ago, if artificial intelligence had come along, you would have time to read up on it. Now you got to buy first and ask questions later, right? You can't afford to, quote, FOMO and this miss out. So for someone like you who is thoughtful, reads a lot, student of history, we're going to get into some of the history business books that you've read over time, which kind of shaped you, I think, a little bit. How do you marry kind of the immediate gratification and need to invest and follow money in versus, like I mentioned before, tell people to take a step back, be thoughtful, and kind of work through a thesis longer? Does that make sense? It just feels like this market has just been about jumping the gun on everything and ask questions later.
I would say it's very difficult to keep up with the market right now. And even if you're living on Twitter or Reddit, there's such a volume of information that's coming at all times. And when you're looking at that, you're looking at the charts, you're looking at the data, and you're trying to create your own charts and your own commentary on the market. It's actually, it's a ton to keep up with. And I feel overwhelmed doing it. And I spend 24 hours a day on this stuff. But there is so much that even I miss on a day-to-day basis just because of the volume. But I think what I try to do is, okay, look at the data. I see reason for caution. But ultimately, I'm a very, very big believer in America, right? So one is I'm optimistic that big US companies will be able to figure themselves out. And I think investors also believe that long term. So stocks generally go up. That's the oldest story in the book. But there's a reason for that. And I think that is what arms me with optimism. And I try to write from an optimistic point of view, because I see reasons for bearishness, and there's always doomers out there, and sometimes they're right. But I think more often and over the long run, the market is always favoring the optimists.
Yeah, I've been saying this for weeks, but this, I think it's very evident that the stock market is not the economy, and the economy is not. And when you try to put economic numbers into the stock market, just like you said, companies can do a great job of bobbing and weaving through it. So you really have to ignore that noise. And people should listen to these conference calls rather than listen to economic figures, because the companies are going to tell you in real time what they're seeing and how they're adjusting. So I think that's great advice. So, all right, you put out a blog, I think in April, about your favorite books. I mean, there's 100 books on there, and you put them in all different kind of categories. Some I've read, obviously. But the one was missing, and I said to you the other day when we were talking, I said, I cannot believe when Genius Failed, The Rise and Fall of Long-Term Capital wasn't on, for whatever reason, you missed that one out of 100. But we'll talk about that in a minute. But talk about kind of the books and what books, whether it's a story about Jesse Livermore, stock operator book, all that stuff, what book resonates with you kind of most, that you kind of think about the most?
So the book that I always recommend to people in markets, if they haven't read it, is The Lords of Easy Money. And that book, I think, gave me my best crash course in the Fed compared to any other book I've read. And what it really establishes for me when I read that there's a difference between inflation and then asset price inflation. So we have goods inflation, we have asset price inflation, and that book really lays it out how you have to really look at both. And I'm not even sure that, let's say, our Federal Reserve today is paying attention to asset price inflation. So when I say that, I mean stocks have been going up a lot in the past 5 years, let's say, and it's we're every other week we're looking at record highs. And that is not necessarily only because the businesses are so robust today that they justify these stock prices. I think a lot of it is just asset price inflation due to policy. So another book that I think left a mark on me as far as my understanding of markets, The Smartest Guys in the Room.
Yep. Bethany McLean, who's been on the podcast.
Yes.
Here. Yeah, she's brilliant. Yeah.
That book, I think it's such a cautionary tale. And I don't know if there's any fraud in the biggest companies in the world right now, and I would never claim that there is because I have no way of knowing that. But you saw in The Smartest Guys in the Room, it's possible for a company to look too big to fail and to definitely be not too big to fail. And that lesson, I think, really permeates if you were to extrapolate to today's AI companies. There's a lot of massive valuations that have pretty much come out overnight, right? And we're going to continue to see that for months, I'm sure.
Well, there's hubris, and then there's outright fraud, and then there's expensive stocks, right? So let's put those in. But I think you bring up a point which I was going to get to, which is right now with kind of the, I would call it lax SEC, DOJ, it's more important than ever that individual investors protect themselves, or at least arm themselves with more information and scrutinize more than they ever should. And so you bring up a point where what I try to do is just protect investors from themselves and just say, okay, no matter whatever stock you're buying, Supermicro was a good example, right? SMCI, which had some accounting irregularities and the stock, you never really, once you have it once, normally it's more than once, whatever, the stocks have a hard time. But my point is that you got to be in the right names and clean names. And I'm a big believer in, maybe you give up a little bit of growth by owning an Alphabet, right? Or a Microsoft, where you get the elements of an AI trade, but you're not all in on the AI trade, but you're going to participate on the fringe. So give me your thoughts on that, because it is too often that we see, and I'm worried about meme coins and stuff like that for retail investors. How do you try to guardrail them a little bit? And I'm sure you've written stuff about that as well. So,
it's a real tough balance, because you obviously have the hype on social media is going to tell you to pile into the fastest horse all the time, right, in the stock market. But then if you look at, let's say, a super established company like Alphabet, and each of their business arms could be standalone companies like YouTube and Chrome and their cloud business. These are all enormous companies if they were to spin off. But the performance for some of these smaller, let's say the chip makers or these new AI startups, they've just blown Alphabet out of the water, and other sort of legacy giants with really great margins and business models, but the stock performance hasn't compared to some of these newer names. So really what I try to do when I write about these things, I'm not one to make recommendations on where to put your capital. However, I think giving the data on, okay, does this company warrant a valuation that we've literally never seen ever before? And we don't know, we can't see into their finances. We don't know how long this business will last because it's only been a year old anyway. These are things that I try to break down in as plain language as possible, and then let readers make their own decisions. And I think, to that point, if you look on X, you will see a lot of noise, but then also it's a great way to gauge sentiment on a name. So if you see a bunch of people talking about a single stock and everyone is bullish, that could, for one, you could say that's a sell indicator because everyone's on.
That's what I used to think from a behavioral finance perspective, but that has not worked. But please continue. Right.
Well, no, I agree. So it's if you look at these that volume of bullishness, you could say it's a sell indicator. However, as you mentioned, it's not always that simple in the internet age because the speed of information is so fast, and a lot of people will not be behind the trade just because they're perpetually online. And I don't know if I explained that fully, but what we try to do is effectively give all the available data and information and say what everyone on X is saying, and then readers make their own decision based on all that information together.
Yeah, I think your slogan is markets move fast. We try to keep you ahead or stay ahead. So I think what you're really describing, though, is when does a secular trade become cyclical? Like, to your point, you have this growth, massive CapEx, and just when you think that it might be slowing, there's, new deals are being done, new deals are being struck. And so whether it's the big CapEx allocators that are out there, people are looking for the signs that it's going to pull back. It really hasn't happened yet. So we'll see about that. So talk to me about some of your recent stuff that you've kind of put out and what resonates with the people that you've been talking to the most. And I'm not telling you to be bearish or bullish or whatever, but what's kind of your current sense of things, just where the market is exactly right now?
I'm very optimistic.
I know we're optimistic, but
Yep.
you can be optimistic about how you're going to do. That's a famous line from The Big Short. But I was pessimistic. But anyway, keep going. Yeah.
I think there are a lot of tailwinds that support a sustained bull market right now. That said, I think the government debt is going to be a forever potential risk, right? And that's going to be under any administration, under any cycle in the business cycle. That is what it is, but because it's expected to stay forever and we're never going to bring that debt down, I don't think so. You can almost discount it because you're not going to be able to do anything about it or manage risk around that. And that might be my youth showing, but I do think we can focus on other parts of the market as far as the tailwinds that will push stocks higher. I don't think the AI trade is going to give out anytime soon. I think the companies continue to make huge amounts of money every quarter, and that's not going to slow down. I think rate cuts are going to propel stocks even higher. And I think stocks have really been optimistically positioned all year expecting rate cuts, and just because we haven't gotten them yet, somehow that hasn't slowed stocks down that much, and we're just on this precipice of, okay, we're about to get cuts, and that's been almost every month of the year. And now I think markets really 90% odds that we're going to get a cut in September, so that's going to be a huge tailwind for stocks. And of course you have the tariff risks. I think that's very real, and those will be start and stop probably through the middle of next year, maybe. I don't see that going away anytime soon, and I don't think the Trump administration is. I don't think they have the most clarity on what the end goal is, right? So you have the effective tariff rate, which has fluctuated quite a bit, and yet somehow markets have pushed through all of that, continuing to hit record highs, and I don't think that's going to slow down anytime soon.
All right, so let me say a few things on that, just to point it. So the market's pricing in the rate cuts, so it's already should be in products that are kind of out there, on the yield curve, et cetera. So to me, it's priced in. The debt, which you kind of want to ignore for a period of time, and I can't push back on that we've been dealing with this debt growth now for years. We've raised the ceiling now another, $5 trillion, so we don't have to worry about it till $41 trillion. And so, okay, I get it, but what you're describing is not a long-term sustainable path. And the thing that amazes me is we're talking about behavioral finance about, you're supposed to project in the future, discount back. At some point, it might matter. And you look at these auctions in the Treasury market, and again, I think we overanalyze those, and I'll tell you why. When yields move on the 10-year from 4.45 to 4.2, and you don't have a great auction on a 10-year, well, it moved from 4.45 to 4.2 in a period of a week, so people aren't as hungry for those as they would be. If it had been back at 4.4, the bid to cover might be better. So a lot in there, but it just feels like a lot of stuff that you're talking about, and you're not alone in this, by the way, and I'm not saying you're wrong, but your entire generation of investors only knows that the Fed has your back. We're going to print money if we have to get out of this thing. As long as the dollar is still the world's reserve currency, things will be fine. And, maybe I'm overthinking that, but it's really what you're saying, because this has been such a financialized driven economy, and it has been. And we are so obsessed and dependent on 10-year yields getting over 4.5%. The market has a signal sell-off. If you really believe the economy is going to be strong enough, you should worry about. You get my point. Like, it's way too fragile, I guess, at various points. And so, talk about that fragility, because when those things do start to happen and market sells off and the rates move higher, then it makes sense, right? It's like, okay, well, that makes sense. Cost of capital is higher, risk-adjusted returns, you're going to need more. So talk about that, because you've been writing now for a while. We've had, I want to say 7 or 8 incidents of massive sell-offs. When I say massive, 3, 4, 5, 7, 10% type sell-offs that have occurred quickly. So when that happens, like I don't know what you wrote, during the tariff stuff. I didn't go back and look what you wrote in early April, but tell me about that experience, because I feel like we're going to have a lot of that bumps in the road.
I think you're definitely right about how younger generations have pretty much never seen severe risk in the market, right? So the market's been able to muscle through almost everything in the last few years. And I think this goes back to the stock market is not the economy. So we know that the Fed is the backstop for markets. And in a way, Trump has been a backstop to markets as well this year at several points. I don't think it's the same thing to say the Fed is good for markets as the Fed is being good for the economy by printing capital. Let's say they're printing cash all the time for years now, and that is going to fuel asset prices higher indefinitely. So I think that is almost a new tailwind of this generation that we haven't quite seen before. And it's also a severe, let's say, inflation risk for consumers. So over many, many years, that's a bad thing for consumers, but a good thing for investors, because your portfolios will get bigger, but the purchasing power of your dollars gets smaller. So that, I think, is not a good thing. But ultimately, that will push markets higher. So that's sort of where I'm coming from. And I don't think there's a way to stop that. I don't think that really has to do with the president or even Jerome Powell. I think that's a structural change that we've seen. And you'd have to be a very, very contrarian Federal Reserve chair to push back on that trend, I think.
All right, so let's talk about crypto, because I know your partner, Anthony, has been following it for a long time. You obviously follow it, you write about it. What are your thoughts here? And, as far as guiding people to maybe how big it should be in their portfolio versus other things, equities in general, how are you guiding people on that? And what are your thoughts in general on it?
So Bank of America's Global Fund Managers Survey came out this week. And of the client respondents, I think it was 75% do not own any crypto. And I think I think owning zero is too low, right? And most people do not own any crypto generally. I think it's really easy to forget if you're in markets 24/7, you see crypto all the time and talk about crypto, and you see people making trades in Bitcoin and ETH, but it's not mainstream really, on a global scale, it's not really mainstream. And that capital will continue to flow to the major assets like Bitcoin and ETH. And my partner says Bitcoin's like a black hole for capital, because eventually all capital is going to get sucked into Bitcoin. And this goes back to the Fed thing too. If we go with the assumption that the Fed will never stop printing money, then your dollar will be devalued precipitously over many, many years. Bitcoin is going in the opposite direction over many years. So to me, that makes a very simple investment thesis, I think. If you say, okay, if you keep your US dollars, you're going to have the same amount, but it'll be worth less. Or if you put capital into Bitcoin, you'll have the same amount, but it'll be worth more in however many years. So to me, that explains the story of Bitcoin as easily as I can. So I personally, I think Bitcoin is a good investment, and I wouldn't recommend people get into it if they don't like crypto or if they don't know about crypto. I think I'm very much in the camp of you should invest what you know, right? But the ETF launch last year for Bitcoin, I think that has really changed the entire landscape, because now you have older generations that want nothing to do with crypto. Well, now they can just buy in an ETF, and even if they know nothing about Bitcoin, they can just look at the price action on the ETF, and that's almost a compelling enough bull case for many investors.
Well, yeah, and they feel safe when it's backed by BlackRock and Fidelity, sponsoring it obviously, versus them going and having a digital wallet or some kind. But the one area I have a real problem with is the crypto-related securities of companies that net asset values are 3 to 4 times the underlying, that they change their entire treasury to go out and buy. Why would you ever own those at a premium to the underlying asset value than just, to your point, going and even buying the ETFs on their own? That's the kind of stuff that reminds you of 1999, 2000 stuff. So I don't know if you've written on that, but there's a handful at this point. There's many. I see an announcement every day. We saw during the dot-com bubble in 99 and 2000, really kind of towards the tail end, you had gold mining companies converting into .coms. You would just change you had banks that would change their name to .com, and they just makes no sense to me. And that's the stuff that scares me in the froth. And when you think about it, when you're converting your business model to become basically a crypto treasury company, so to speak, you're on this continuous hamster wheel that you have to keep issuing equity at a premium to then have and keep buying it and buying it. At some point, at some point that starts to come back the other way. And that's the part where I'm not saying it's going to happen tomorrow, next, but do you track that at all? Because there are a handful of securities out there that are like that.
I think it's, I do pay attention to it, and it's worth monitoring. I don't know if these Bitcoin treasury companies, or
Ethereum also, yeah.
Yeah, Ethereum too. I don't know if they would ever be able to exhaust the total supply. So, right, there's a lot of speculation, I think. Okay, what if 10 crypto companies own the majority of all Bitcoin circulation? I'm not sure if that's happening anytime soon. And even if it does, in theory, investors or someone will be owning those assets anyway. And it's almost agnostic as to who owns them. You could make the case, right? So I don't know if that's a risk to the underlying asset, just because the concentration of owners is narrowing, let's say. I don't know if that really changes the fundamental thesis to Bitcoin of the dollar is going to get debased into oblivion, so buy hard money. I don't think that changes that.
I guess my point is that the survey you were talking about with Bank of America about people that don't own, I think it's higher than that when you count the securities related to owning Bitcoin.
That's fair.
Owning MicroStrategy or strategy doesn't count as owning crypto, right? Technically speaking. So that was my point. All right. So talk to me about, I know Anthony's having an upcoming conference that you're going to be there for, but also talk to people about how they can find you on Substack, how they can subscribe to Opening Bell Daily, et cetera. Walk me through all those.
Yeah. So Anthony is hosting a investor summit in September, and all the information's you can find it on X, you could find it on his website, on my website. We write about in the newsletter, Opening Bell Daily. And to find the newsletter, you could Google my name, you can Google Opening Bell Daily. It's a free newsletter. We publish it 5 days a week, and it comes in to your inbox at, 5:45 in the morning.
Yep,
every day. And so I would like to believe that if you read that every morning, you will be fully up to speed on everything going on in markets, because if I didn't believe that, I would not be doing my job well. So that's what people can expect in that newsletter. And we also have our premium subscription for our Sunday research reports, which is a specific stock or investment idea. And we break down the thesis, the risks, the data, the charts behind a single stock pick. And those are sourced from interviews with investors who are really good at what they do. And
so that's the Best Ideas Club?
Yep, Best Ideas Club. And right now we just published our sort of mid-year report on Best Ideas Club. And our portfolio, I think we had done 26 stocks so far. I think it's up about 13% this year. And the S&P in that time, from the first day we published, is up like 6%.
Is that just the same allocation on every one of the
ideas?
Yep,
equal weight portfolio.
Interesting.
Yep.
So you're going to turn that into an ETF at some point? That seems
never
to be the
say
trend.
never.
That seems to be the trend these days.
Never say never.
Well, Phil, listen, you're wise beyond your years, and I can't thank you enough for coming in and sharing this. And people should read your books, follow you on Opening Bell Daily, and I look forward to you working on another book right now. It feels like you're always writing or reading. So you have a book right now you're working on?
I don't want to give anything away, but maybe something soon will come out.
Fiction or nonfiction?
Be about markets.
Be about markets. So, like I said, fiction or nonfiction, because we're living in a
nonfiction.
Nonfiction about the markets. Okay, well, we're looking forward to seeing that. And Phil, thanks so much for coming on the tape.
Thank you, Danny.